Today, our topic is, what will the job market look like for graduates this year? My name is Kevin Miller. I'm the Vice President of Marketing and Sales here at Chmura, and I will be serving as your host today. So before we get started, I do have a few housekeeping things to quickly go over. For everyone that is live on the webinar today and everyone that did register for the webinar in advance, we're going to go ahead and send out an email soon after we finish today. It'll hopefully be this afternoon. If not, it'll be tomorrow morning, more likely than not. That email will have a link to a recording of the webinar. It'll have a link to download the slides. So if you want to see the slides, that's how you can get to them. So keep an eye out for that. We'll probably also post about this with that landing page, with that information on social media here in the next couple of days. The other important housekeeping thing is that during the webinar, just please ask questions. We highly encourage participation with those questions. The easiest way to do that, and then so we can just keep an eye on things, is put the questions in the chat. And at any point during the webinar, put them in the chat at any point while we're speaking during the webinar. At the end, we'll get to as many of those questions as we can. One thing to note is that if you do see the question move out of chat, there's a Q&A tab that I tend to move things over to, just so I can see all the questions and keep things somewhat organized. So with all that said, we'll just go ahead and get started. So today, our speakers will be Dr. Chris Chmura, the founder, CEO, and chief economist of Chmura Economics and Analytics, and Alex Doherty, who's an applied economist on our team, and he's going to be a familiar face and a familiar name to a lot of our JobsEQ users. Alex is one of our main trainers on the platform and is also one of the folks that is heavily involved in the chat feature. So if you guys have a problem with JobsEQ or have an issue finding data, Alex is usually one of the people that will help you out. So for those of you who are new to our webinars, we do like to start with a quick overview of who we are and what we do as a company. So as a company, we provide labor market data and analysis through three main offerings: our JobsEQ software, our consulting services, and then access to that data that's contained within JobsEQ. We were founded in 1998 by Chris, one of our speakers today. We have offices in Richmond, Virginia, where the three of us here are located. And then our other main office is in Cleveland, Ohio, but we serve hundreds of clients all over the country. And as a team, we truly care about helping our clients get access to the data they need to help grow their communities and organizations. And kind of as we're thinking through what guides us as a company, really the thing that we always strive for is excellence. Excellence guides us and is always what we strive for in customer service and data quality. We often hear from clients about how those two things really differentiate us from some similar products that are on the market. In addition to excellence, the three other ideals that we adhere to really every day in our work are being thorough and accurate with our data, and making sure that our offerings are useful to our clients, and really that we are serving their needs with our products and services, and really all of the transformation and things that are improved in JobsEQ really come at what is desired and really the feedback that we receive from our user community. Just for some folks that don't know us too well in the markets that we serve, the primary audience that we serve are in 6 verticals, those being corporations, economic development, education, site selection, staffing, and workforce. And then just to kind of get a sense of who those organizations that we do work with are, here you can see a representative sample of the clients that we serve. This is in no way comprehensive, but it just gives a really good overview of the type of clients that we serve every day. So anything ranging from major corporate clients through 2-year and 4-year educational institutions to a number of public sector clients in economic development and workforce. So now all that said, I'm going to go ahead and turn it over to Chris to get us started. But thank you all for joining us today.
Great. Thanks, Kevin. Before we get started on the webinar, I want to remind you all that we do have a weekly publication that comes out, and with the economy being so much up in the air in terms of a recession, I think it's an important time maybe to get this publication. We provide it at no cost to you, so you can click on this link later and sign up for it. Also, I'm very happy to announce that we have a date for our next JobsEQ Users Conference, and that will be January 23rd through the 26th in Orlando at Lowe's Portofino Bay at Universal Studios, I guess within walking distance. In fact, if you've heard of this hotel or looked it up online, you may be saying, oh my gosh, I could never afford that hotel. The rates are about $489 a night, but we did a great job of negotiating, and your rate for the conference will be $279 and no resort fee. It'll be a great time to talk to other people about Jobs EQ, find out how they're using it, learn from some of the experts. So I hope you'll consider joining us. Okay, now on to our webinar. So we're looking at the economic outlook for graduates, and I will be given the first part, the big macro perspective, and the job market right now remains strong. We'll look at that, and we'll look at the impact on wages from inflation. We'll talk about the potential for a slowdown later in the year, and then I'll end with talking about higher interest rates and how they will influence and have been influencing growth. Then we'll switch over to Alex, and he'll give you more detail on retirements, how that's affecting recent graduates. He'll talk about job openings more specifically and hiring trends, program enrollment relative to demand, and he'll give more detail on trends in job postings and wages. So at the national level, the first thing, employment is very strong. Here you see employment growth and the huge drop off because of the pandemic. And now we're above pandemic levels. In fact, we're 3.7 million jobs ahead of the pre-pandemic level. When we look at it in terms of a monthly gain, so each one of these represents how many jobs were created in that month. 900,000 jobs in 1 month is very strong. In fact, anything over 300,000 in 1 month is very strong. And the last number that we saw, economists were expecting in May, it would be somewhere around 100,000. It was in fact 339,000. So the job market remains very strong. Employers continue to hire people, but we are seeing a little loosening. The unemployment rate inched up to 3.7% in May. But when you look at it historically, it's still extremely low. So we're starting to see things changing a bit, but still the market remains very strong from the job market perspective. Initial unemployment claims are considered a leading indicator. They come out every week. And last week, June 3rd, initial claims jumped. This is one entire week of initial claims jumping. That looks like an ominous sign. 1 week does not make a trend. So when this number comes out Thursday at 8:30, many people will be watching to see if that trend continues up or if we start to see that come back down. And again, this is a very strong leading indicator because if you're laying off people, then you're not hiring them and business is slowing down. So we'll be watching this one very closely. Another leading indicator are job ads. So this comes out of our Jobs EQ tool for those of you who use it. The blue line shows you the job ads for this year. We spider over 40,000 sites. We deduplicate the data, and then we show the data on what we call RTI and Jobs EQ. So this is this year's data, and in gray is last year's job postings. And notice it was around July that we started to see job posts decline. And right now they're down 16% since July 27th. Again, another leading since June 27th, 2022, sorry. Another leading indicator because you don't put a job ad out unless you expect your business to continue to grow. Your goods and services continue to be in demand. And so now when we see less firms putting out job ads, that suggests that they're more apprehensive about what the future economy is going to look like. In terms of our forecast, GDP, gross domestic product, is the broadest economic indicator. And here you see the COVID recession. It was sharp and deep, but it was did not last long. The Great Recession prior to that was the worst recession since the Depression, and it lasted longer than the COVID recession. Looking ahead, the last data that we saw for GDP growth was about 1%. We're expecting it to slow. In red is our forecast in the second quarter, and then we're expecting negative about 1.8, 1.9% in the third and fourth quarter. Then we see a rebound. Anything above 2% is considered very strong growth. So during this period, right after COVID, of course, during the rebound, we're seeing very strong growth. as we move forward, we're not expecting to see growth getting up above 2 or 3% very often in the next couple of years. But again, this is a mild recession that we're expecting and not lasting but 2 quarters. So wage growth, how much of an increase are we seeing compared to a year ago in terms of wages? And you could see because of COVID, the huge increase when everything was locked down, and then the decrease a year later. Then inflation started to pick up and wages increased 6% year over year, and they have been slowing since. So latest data showing wages are up 4.3% from a year ago. And of course, the important piece here is it growing faster than inflation. Here back at the beginning or the middle of 2022, we saw wages peak at around 6%. What about inflation? Inflation was up over 8%. So wages did not keep up with inflation. So in real terms, individual workers were not making as much as in the prior year, and so their living standard was decreasing. This morning, we saw the May report on inflation, and it came in at 4.1% from a year ago. So it has been slowing considerably. So at this point in time, as we saw on the previous chart, wages were up 4.3%, inflation is up 4.1%, and so now we're seeing that workers' pay is starting to match what they're seeing in terms of inflation. But that actually depends on what you're purchasing. So in terms of inflation, we can break that down between all sorts of goods and services, all the way down to automobiles, purchasing cars, purchasing bacon, and things like that. So here I broke this out. We're showing in dark black here the year-over-year change in total. Goods are shown in blue. So when we went into the COVID recession, we couldn't go out and spend money. And then we started to do some spending, but we were still social distancing. So we were buying things like Lululemon jogger pants because people only saw the top half of us in our Zoom meetings. Or we were buying some equipment to exercise on because we couldn't go to the gym. And then as we were able to social distance more, we saw a shift toward purchasing goods and items to purchasing services, like going on vacation, going to eat out at restaurants. And so if you eat out a lot at restaurants, you're probably seeing inflation still pretty high. For services overall, it's 6.3%. If you're buying your food at the store, we're seeing some food prices coming down. So the inflation you're experiencing is not as great. So, of course, this all varies by occupation, and Alex is going to go into this in more detail later. But what I did is I looked at all the ads in Jobs EQ. The BLS identifies about 820 or so different occupations. And so I sorted out all the occupations, and I just looked at those that there were 4,000 or more ads. And then I looked at the wages that are in the job postings. Not all jobs post their wages, but this is the mean of those that are posting wages to get a sense of how much they've gone up over this period since the beginning of the year. And you can see radiologists at the top with a large increase. Some other areas where we saw increases are healthcare related. Moving down, Customs and Border Protection officers up 37%, investment fund managers up 28%, marketing managers up 31%. So we have seen some variation in how much wages have gone up over the past 6 months or so. And again, Alex will give you more detail on that. So what's causing all of this slowdown? The FOMC, or the Federal Open Market Committee, meets 8 times a year, and that's with the Federal Reserve Bank. They're actually meeting today and tomorrow, and they determine whether or not to raise interest rates. They're raising the federal funds rate. That's the overnight rate that banks use to lend to each other. It's the only rate the Fed can directly affect. But when they raise the federal funds rate, other rates tend to go up. So you see the prime rate going up in lockstep. A 3-month might go up. Automobile loan rates go up. And so they went from 0 to 5%, raising it 10 times over the past year and a half. And that tends to ripple through the economy and slow the economy down. So it takes a year or longer for that impact to affect the economy. And so we are just now seeing the impacts of those increases from earlier last year, and we'll continue to see these higher increases of slow down the economy. When we look at the entire yield curve, those of you that aren't used to seeing it, this is the maturity. So you can hold a treasury bill for 3 months, for 5 years, 10 years, 30 years. And as we hold it for a longer term, you expect the interest rate you receive to go up because there's more uncertainty over a 30-year period than over a 3-year period. What we're looking at right now is very different. It's called an inverted yield curve, because the 3-month yield is much higher than what the 10-year yield is. You can get 5.5% interest if you hold a treasury bill for 3 months, and only 3.7 or so percent if you hold a 10-year. This again is called an inverted yield curve. And since the 1950s, every time we've seen the curve invert, we've ended up in a recession a year or so later. That's one of the main reasons we're expecting to see a recession, as well as because we're in the third and fourth quarter of this year, as well as because we start to see some softening in the job market overall. So in summary, on the national part, we continue to expect a recession in the second half of 2023. Wages and the job market will ease, but as you'll hear from Alex, right now, even though things are easing, we are at a historically strong job market. So it's a good time to be graduating. Alex, let me turn it over to you.
Thank you, Chris, and good afternoon, everyone. Thanks for joining again today. So we're going to start off by looking, taking a deeper dive into the current labor market conditions for young adults graduating high school, a community or technical college, or a post-secondary, other post-secondary program. So first, we'll take a look and see, okay, what does the state of the economy look like for those current graduates? Well, first, let's take a look at labor force participation rates. And here we have those labor force participation rates broken out by age group. So here we're able to see, okay, what's happened basically post-pandemic here after our blip in 2020. And it looks like, for the most part, labor force participation rates have normalized after the pandemic. If we look at in orange there, those 16 to 24-year-olds, they have returned back to where their participation rate was before the pandemic, at around that 56-57% participation rate, up from that low of 49.2% in April 2020. We've seen those 25 to 54-year-olds right there at the top of the screen in blue and dark gray have generally rebounded as well. But at the very bottom here, we see the impact of the pandemic on those 55-plus-year-olds. It's normalized for them post-pandemic, but it certainly doesn't look like it's rebounded, right? We see that we had that drop from the pandemic, and then it's generally stayed low. It hasn't come back up to that 40%, above 40% level that we saw. It's staying significantly below that. So that might make us think, okay, what's going on with those 55-plus-year-olds? Is the pandemic possibly causing an early retirement? Pandemic influenced early retirement for those 55-plus-year-olds. Well, we can dive into that a bit further here by looking at the census's Household Pulse Survey, and this is surveying all adults 18-plus years old. And this one question that we're looking at is why, of those adults who are not working, what is their primary reason for not working? And we're looking at this kind of year over year in time series, starting off with the very first survey in May of 2020. And there we see it's dominated by 41.2% in dark gray there. They are primarily not working due to COVID-19 related issues. And that could be from being sick because of COVID, taking care of someone who was sick during COVID. Their employer might have temporarily or permanently closed, or they might have been furloughed due to COVID. So we see that proportion of adults who are not working has shrunk over time as the pandemic has become a smaller labor market concern here. It's shrunk from 41.2% of the reason for adults not working down to 6.9% of the reason for adults not working in the labor market. On the flip side, we've seen the percentage of 18-plus-year-olds not working due to being retired as significantly increasing over time. So further evidence that that retirement rate has really increased over time over the past several years. There are a couple other things that we see here that are interesting to note, like the percentage of people who are not working due to being sick from something unrelated to COVID has actually increased year over year here. That might be because the world was generally healthy, right, when we were all inside, or at least healthy from a contagious standpoint outside of COVID here. But if we actually look at a couple other points, we see the percentage of people not working due to childcare has actually fluctuated a bit, but still been around that kind of 5% mark in light blue there. And then their percentage of people who are voluntarily not working was fairly small in 2020, but it's ballooned back up to that 5 to 6% range since then, and then a variety of other reasons in light gray there. And then if we look at our next chart here, we're seeing, okay, what's the actual impact of those early retirements? Well, we're also seeing the percentage of the US population who are aged 65 plus. Those 65 plus year old, their proportion of the overall US population. That has increased historically, and it is projected to continue to increase moving forward. So what's this impact of the kind of the graying of America and additional retirements? How does that influence young adults, right? Well, the more retirees that we have per young adult contributes to that ongoing labor shortage that we're experiencing. And it's actually a nice silver lining for young adults entering the labor market that they might continue to have very much a job seekers market moving forward here, as we expect that labor shortage to potentially persist, maybe not to the same level, but that labor shortage might continue to persist over time. And that is kind of further shown in this next chart, where we see the ratio of working age adults, those 25 to 64-year-olds, to retirees in the labor market here. We're shifting from over 4 working adults for every retirement age adult to just over 3 working age adults per retiree right about now. And that trend is expected to continue through the 2020s and 2030s as we drop closer and closer down to only 2 working age adults per retiree here. So again, that really amplifies the labor shortage and provides great opportunities for young adults entering the labor force. Next, let's take a look at job openings and quits rates, or resignations, within the labor market. We see that in orange here we have the job openings rate. And over time it was steadily increasing, then dropped from the pandemic, and then it really shot up kind of pretty soon after the pandemic from late 2020 through 2021. And it has dropped a bit over the last year or two, but it's still well above. Job openings are well above where they were before the pandemic here. If we also look at quits rates here, we see that quits rates increased after the pandemic as it became more of a job seekers market, and job seekers were more confident changing jobs, right? Job seekers are more confident changing jobs when the economic climate is good and positive and there's less uncertainty. When we look at quits rates historically, quits rates tends to decline during recessions when there is less economic uncertainty. And we really see that in gray here. Over time during the recessions, that those quits rates have really declined. We saw that decline during the pandemic, and then we've started to see that a bit more over the past year or two, but the quits rate is still well above where it was before the pandemic there. So not quite as strong as a year or two ago, but still relatively strong compared to the past decade or two. Now, if we look at hiring, well, hiring rates are well above where they were compared to before the pandemic. And we're looking at these hiring rates at different education levels. So we do see at the very end here, there was a dip from 2021 to the first quarter of 2022, right here across all individuals, regardless of their educational attainment level here. But we do see that, okay, the dips were pretty sharp for those with some college or an associate's degree, a high school diploma, or those with less than a high school diploma. We really take a look here, the slope for that light blue line is less severe than it is for those other three lines. And that's really indicative of the fact that those individuals that have that bachelor's degrees are a bit more insulated from that decline in hiring. And we also see that during the pandemic. The drop from 2019 to 2020 was the least severe for those bachelor degree owners, bachelor's degree or higher owners there, that really helps insulate from those pandemic-related declines in hiring. Next, we're looking at post-secondary programs over time. Here we're just looking at the 7 largest education programs, the number of degrees conferred within each program over time over the past 11 years or so. We see degrees conferred in health programs up there in orange. Those are programs like registered nursing. Those still make up the largest single component of total degrees conferred. And those health conferrals were relatively steady, but they didn't really change a whole lot over the 2010s or so. There's maybe that slight increase from 2010 to 2011, and then kind of a slow, steady, maybe decrease through 2020, and then a slight uptick in 2021. But again, pretty steady, not changed a whole lot. Well, if anyone's familiar with online job ads or familiar with your local labor market, chances are that job postings for registered nurses are through the roof. It's usually one of the top occupations in demand within the region. And for anyone within the education sphere working in that program development, curriculum alignment space, looking at your specific region, looking at these data, we can really see, okay, maybe there's room to continue to expand that registered nursing program within our school or within our region. That demand is there when we look at those online job ads relative to those degree conferrals within our region. We really see that. Now, further down here, and it's a little hard to see, so I'm going to try to highlight it with a little color here. Bear with me, hopefully this works. Those computer science and support degrees, there were 120,000 degrees conferred in 2010 or so, and that's kind of right down there in 2010. That's what we're looking at. Well, that has shot through the roof to over 250,000, 253,000 degrees conferred in that 2021 academic year. So that program has more than doubled the number of degree conferrals in the past 10 years. Well, if we think about it, computer science and support positions, those occupations are very much in demand. So that's one area where we can really see, okay, schools have realigned and adjusted to employer demand within the region, and students are attracted to these jobs because they are in demand and they often pay very well. So that's a nice little trend to take a look at there for that computer science and support position. Now, I will go ahead and clear that off and jump into our next slide here, where we're going to start looking at where are the current jobs for recent graduates. Well, job ads have really grown everywhere in 2022, but the last 6 months or so really tell a different story. And let me take a step back and describe kind of what we're looking at here. we basically segmented the country into every single county within the country into different markets. Is a county a part of a giant MSA like LA or New York City or Chicago? Are they a part of a large MSA with where the total MSA population, metropolitan area population, is in that 1.5 million to 6 million range? Or are they in that medium MSA range, in that 500 to 1.5 million range, like Richmond or New Orleans or Salt Lake City? Or are they within a smaller metro area like Atlantic City or Boulder or Wichita Falls? And then all of the other counties that are not within metro areas. Those are usually those micropolitan counties or more rural counties across the country are in their own category here. So we grouped them all together and looked at job ads aggregated for each one of these categories. And we can really see over time that they've generally trended together. Right, the rebound from COVID, we really see happening. But one interesting thing to note here is over the past 6 months, we see something, a bit of a divergence here. The number of job ads within giant MSAs has actually declined over the past 6 months, if we look at that in greater detail, which we can take a look at within this next slide here. Within that red box here on the right side of the screen, we really see, okay, those giant MSAs, job ads, active job ads have declined by 6% over time over the past 6 months. We can really juxtapose that by what's been happening in the small and medium city or metropolitan areas, where job ads have actually increased by 10 and 11% over the past 6 months. So typically individuals who are seeking out that bachelor's degree or higher, they're often looking at those major MSAs to go pursue work. Well, this really shows us, okay, maybe a lot of the major opportunities over the past 6 months are actually in more of those small and medium-sized cities across the country that we really see popping up right there. Now that is the story for the past 6 months. Obviously, all of our regions have significantly rebounded from the end of the pandemic, and they're all still above where they were before the pandemic. Although those giant MSAs, those LA and New York City, Chicago, et cetera, are only in that kind of slightly above where they were before the pandemic. Next, let's take a look at job ads, post-pandemic job ads by education level here. So let's take all of the job ads again across the country and look at, okay, all of the job ads requesting candidates with a certain education level. How have those trended over time? We have all of this indexed to right before the pandemic, to February 2020. As that being equal to 100. So we see, for example, job ads seeking candidates with a doctoral degree are 33% higher than they were in February 2020. That's that kind of burgundy line up there at the top. 22% higher for master's degree candidates in that light gray there. Job ads for individuals with bachelor's or associate's degrees, as well as job ads that don't specify a degree requirement, are right around where they were before the pandemic, about plus or minus 2% or so. Job ads for individuals with a high school diploma are actually 21% lower than they were before the pandemic. But if we look at the actual raw numbers, we're really able to see that the raw numbers really paint a different story, right? We have up here in orange all of the job ads that aren't requesting a specific education level. They account for over half of all job ads. But for those job ads that do require a specific education level, that high school diploma or a bachelor's degree are still those predominant, are predominantly what's being requested by employers. Right here. With the job market as tight as it is, some employers have started to remove degree requirements, which is one of the reasons that we can see why unspecified job ads that don't have a specified educational attainment level have really increased as the post-pandemic, basically right here. Now we're taking a look at job ads by major occupation group here. So what types of occupations are these job ads concentrated in? And they're right here abundantly clear that professional services, blue collar jobs, and healthcare related jobs are really at the top here. Where over 4.8 million job ads are out there for healthcare practitioners. Those are those doctors and registered nurses, and a lot of the technicians. There are similarly almost 4 million active job ads over the past year for management-related positions. And we can see if we compared this to our education conferrals, our degree conferrals, we would really be able to see, okay, these degree conferrals are aligned very well with these job ads. Now let's take a deeper dive into an example of what skills are employers actually looking for. Well, if we dive into JobsEQ and take a look at over the past 12 months, what are the top job ads that employers are requesting of their computer and math candidate hires, basically. Those are your computer programmers, user support specialists, and we see right here what those hard skills are. So there are 524,720 job ads over the past year that have, for these computer and math jobs, that are requesting skills in SQL here. So again, this is a great tool for that curriculum development and program alignment here. And if students have these skills, they need to be on their resumes, right? So they're able to get past that applicant tracking system and get that in-person interview here. Same thing, we see what the top skills are continued with Agile and Python, and then Java and JavaScript, and being proficient within AWS, and having strong Linux skills as well. So this is just one example of what we can look at within JobsEQ to see, okay, what are employers looking for out of their candidates, out of the individuals who are graduating with these computer science degrees, just as one example here. Next, let's take a look into remote jobs, because this is always a popular question, right? Well, we really saw those, the total number of remote jobs surge over the pandemic as remote work really became popular, and really the only way of doing a lot of the jobs across the country for the better part of a year or so. Remote jobs surged from about 1.2% of all job ads in February of 2020, right before the pandemic, to about a total of 5% of all job ads peaked there in September 2022. Now, you'll notice this chart is dual axis. We have the total number of job ads. That scale is on the left side, represented by the gray line throughout the chart. On the right side, we see the scale for total number of remote jobs. And of course, our remote jobs scale is much smaller, and that is because they only make up about 5% of all jobs, about 4.8% right now in May 2023. So a significant component, but a lot of the jobs across the country really can't even be done remotely. If we think about a lot of healthcare and transportation and production jobs, and retail jobs as well, that are still so predominant within our economy here. Now, let's next take a look at what wages graduates can expect when they start looking and for work and start within their first jobs. Well, as we know, wages were very stagnant, especially before the pandemic. Throughout most of the mid to late 2010s, pretty much didn't move here. We see kind of jumping all around that 31,000, 32,000 job ad that's equivalent to a $15 an hour average hourly wage right here. But we see post-pandemic that labor shortage really had that upward pressure on wages, and we saw wages really start to increase since early 2021. Now, the next question might be, okay, well, what's been happening over the past year or so with inflation? Have have wages kept up with inflation? Well, if we do similar to what Chris showed earlier, if we compare the wages within online job ads to inflation, and if we basically index them to the same time period, we can see have the advertised wages within these job ads. So only the wages where employers are advertising a wage, are they keeping pace with inflation? And the short answer is yes here. We see in orange here the wages have increased, especially over the past year or so, slightly higher than inflation has been. We're looking at the two measures of inflation, that consumer price index, that's that headline number that you often see, but we're also showing in blue here that personal consumption expenditure measure of inflation that the Federal Reserve likes to use to monitor inflation here. Now, there are a lot of contributing components that could come into this, like maybe only companies that are job ads that have wages are biased towards companies that post higher wages because they're more comfortable being transparent with those. Maybe it could be biased towards the mix of online, the mix of occupations within online job ads. Maybe there's a greater proportion of jobs with higher wages. And the answer to that is that's certainly something worth diving into, but it's a bit more complex to dive into and kind of is its own project. But this is nice to see overall that in general, wages have kept pace with inflation. Now, I've got one more slide to look at here, and I'm going to request a bit of imagination from our audience here to ignore the title and the changes since February 2020 on the right here. I was in the midst of making some edits here, so this is actually not correct. So we're going to look at a couple different things here. But we'll still talk through here because the chart data itself is nice to see, where we can really see the wages for each job ad over time within each educational attainment level. We see that wages for job ads requesting candidates with bachelor's degrees have actually increased the most since before the pandemic, and that's actually an increase of 39.8%. Ignore the numbers on this chart. We'll get that fixed for distributing it. But we really see across the board, wages have significantly increased since February 2020, since the start of the pandemic. Now I would love to give the opportunity to everyone to get some questions in, and I will turn it over to Chris to wrap up for today before we start taking some questions.
Great. Thanks, Alex. A lot of interesting information that you have there. So bottom line, the economic outlook is strong for new graduates. And I think the thing to underline there is still strong. The labor market's in pretty good shape. Inflation has pushed wages higher, so they're looking at better increases or higher wages, especially at the lower skilled level. There are signs of a slowdown that are emerging, and we expect that the higher interest rates will slow growth even further than what we've seen so far. Recent retirements are offering opportunities for younger adults to move into those jobs and to move up to areas where individuals have retired. Opening and hiring trends have cooled off from record levels, but again, we're still looking at some very strong demand out there. It's nice to see that the program enrollment on the college side is matching demand, and in the charts that Alex showed over the longer term, that wages are keeping up with inflation. So with that, now we have a few minutes left. If there are any questions, we'd be glad to try to answer them. Or if you have any comments, that'd be welcome as well.
Thanks, Chris. We got a couple that have been dropped into the chat already. So for everyone still on the line, if you have any other ones, just go ahead and drop them in the chat and we'll try to get through them. So the first question is from Rick Clifton, and he says, while the job market may be great, all I hear is that we can't get people back or get people to work. What do you see as a problem in getting people back into the workforce? That might be one for you, Chris.
Yeah, that's a question that a lot of states and regions are dealing with and trying to figure out, and we've in fact done some studies on that. And part of it all comes back to the wages aren't high enough. And why I say that is one example would be childcare. Well, in addition to childcare being expensive, there's a shortage of agencies that are giving childcare right now. But you have to consider, okay, is it worth it going and getting a job? Is it going to surpass what I have to pay in childcare? Or if it's a two-wage earner family, is it better for one person to watch the children than to go back to work? So child care is one of the issues. Another issue is the generous unemployment insurance that we have. It was a lot worse just coming out of the pandemic when um, uh, unemployment insurance was much higher. And of course, we need that security net for people when they lose their jobs, but we have to look at that relative to some of the lower wage jobs and encouraging people to go back into those jobs versus staying at home and earning as much just through unemployment insurance. And then another thing that we found is younger people staying in school longer, not taking second jobs when they are in school. And that trend has not just been since the pandemic, but it goes back maybe 10 or 15 years. So that's a very good question, and one that everyone continues to grapple with. But I think wages, having higher wages is one of the answers that will take care of several issues that are at play.
Thanks, Chris. Next question we have is from Tara Lewis, and she says, it seems that employers are unwilling or unable to offer H-1B sponsorships. Is the effect on labor market demand a positive for the domestic student population?
So this is something that Alex and I were talking about before the webinar here today, that one of the issues that would help out with the participation rate and with the tight labor market is if we had some immigration reform that allowed both high-skilled and low-skilled workers, we need them at both ends of the spectrum, to come into our country and take some of these jobs. So that would certainly be a big factor that would help if we could get some immigration reform.
Great. Thanks, Chris. I had one, someone asked for the link to the monthly reports. I went ahead and put that in the chat. So you should be able to find, actually that's for the weekly economic update. I think that's what someone was talking about, what you had showed earlier. Question from Micah Dalton. So, and I guess this goes back to figuring out with people looking at remote jobs. Is the data on remote jobs those which are remote only?
Alex, go ahead, Alex.
Yes, remote jobs are all of those where remote is indicated as a potential working arrangement within that online job ad. It's basically two categories, remote and remote not indicated.
So that could be remote 2 days a week or 3 days a week or 5 days a week, correct?
Correct.
Okay. So we do have the capability. I think next time we do this, we'll want to look at the term hybrid and see how many job ads are now saying it's a hybrid work environment. But I would assume that if it says remote, hybrid is a subset of remote.
Yes, I believe so. I'm going to see if I can find the documentation real quick because I don't want to lead us wrong.
All right, so I'll go ahead and jump into the next question. Next question is, unemployment rates are very low around the nation and where I work. Do these lower rates make it harder for recent college grads to get entry-level jobs?
The unemployment rates, well, actually, with all the individuals retiring, it makes it easier for the college graduates to find jobs. But because we have such a tight labor market, wherever the labor market is the tightest, would imply that the unemployment rates are very low. It should be easier for college graduates or high school graduates to find work. And of course, it depends on the skills that they have and what skills are required by the businesses in the area. And everyone's talking about artificial intelligence now, and that's really come up with ChatGPT and some other things in the last couple of months. And it's interesting. Or even take cyber, for example. Cyber is not one of those occupations that is classified by the BLS. And in fact, it's only been 10 years ago that universities and community colleges have started offering courses to for people to go into cyber jobs. And I just looked at these data a couple of days ago, and over this past year, we graduated about 3,000 people with cyber degrees. And if we look at job ads, there are about 68,000 job openings for cyber. But if we, again, looking at the job requirements or the skills for those cyber jobs that are open, people need things like information security, Linux, Agile, Python, computer networking, Azure, cybersecurity, computer programming, coding. So those are sort of broad skills. So what that says is you don't need a degree in cyber, a diploma in cyber to get work as cyber or to get work in AI, but you do need to have those transferable skills. So for educators who are listening in, certainly knowing the hard skills that the businesses are requiring is important to work those into degrees that you're conferring. And then secondly, individuals who are looking to get into some of those higher paying AI or cyber jobs, consider some of the hard skills, adding those hard skills to your resume, as Alex has talked about. Getting those credentials would increase your possibility of landing one of those good jobs.
Great, thanks, Chris. And Alex put in the chat what the definition for the remote work identification is. So that is in the chat for anyone that was interested in it. Don't think we have a ton of other questions. Somebody did ask if the slide presentation will be available, and yes, we will send that out via email here probably later this afternoon or early tomorrow morning. And then we'll also post it on social media within the next couple of days. So I think that will wrap us up today. Chris, did you have anything else, or are we good to let everyone?
I think we're good to go. Just please let us know the topics that would be of interest to you in the future, and we'll continue to do these webinars as they are useful to you. So thank you and have a good afternoon.